There is a growing conversation in global financial and industrial circles about the future of silver, and recently, a major development has drawn renewed attention to how this market may evolve over time. A leading silver-producing nation has indicated that it does not currently plan to expand new mining concessions, and while this may sound like a localized policy decision, its potential implications reach far beyond one country. To understand why this matters, it helps to step back and look at how silver fits into the global economy. Silver is not just a precious metal used for jewelry or investment. It is also a critical industrial material. It plays an important role in electronics, solar panels, electric vehicles, and various forms of advanced manufacturing. Because of this dual role, both investment demand and industrial demand influence its price and availability. When a country that contributes a significant portion of global silver production signals a pause or limitation in new mining development, analysts begin to look closely at what that could mean for long-term supply. It does not necessarily mean supply will suddenly stop. Existing mines continue operating, and global production comes from multiple regions. However, mining is a long-cycle industry. New projects often take many years to explore, approve, and develop before they begin producing metal. This means that decisions made today about whether or not to approve new mining projects may shape supply conditions many years into the future. If fewer new projects enter the pipeline, future production growth may slow, especially if existing mines gradually produce less over time as resources become harder to extract. It is important to approach this topic carefully and responsibly. Mining output depends on many factors, including geology, technology, investment, environmental policies, and market conditions. No single decision automatically determines global supply outcomes. However, when multiple factors align in the same direction, they can influence broader trends. One key concept often discussed by analysts is the idea of replacement. In mining, companies continuously explore for new deposits to replace what is being extracted from current operations. Without ongoing exploration and development, production can eventually decline. This is not sudden, but it can become noticeable over longer periods. At the same time, demand for silver has been evolving. Industrial use has grown steadily, especially with the expansion of renewable energy technologies. Solar panels, for example, require silver for their conductive properties. As more countries invest in renewable energy infrastructure, demand for materials like silver may increase. Similarly, the rise of electric vehicles and advanced electronics has contributed to steady industrial consumption. These trends are often discussed as long-term structural drivers rather than short-term market fluctuations. However, markets are dynamic. When prices rise, industries often adapt. Manufacturers may find ways to use materials more efficiently, reduce waste, or explore alternative technologies. This process is sometimes referred to as thrifting, where less of a material is used per unit of production. Over time, this can help balance supply and demand. Another important aspect of the silver market is inventory. When production does not fully meet demand, existing above-ground stockpiles can help bridge the gap. These inventories include metal held by exchanges, institutions, and private holders. Over time, if demand consistently exceeds supply, inventories may decline. This does not automatically create a crisis. Markets adjust through pricing, innovation, and shifting demand patterns. Higher prices can encourage recycling, increase exploration in other regions, and bring previously uneconomical deposits into production. It is also worth noting that global supply does not depend on a single country alone. While some countries are major producers, silver is mined in many parts of the world. Diversification in supply helps provide stability, even if changes occur in one region. In addition, silver is often produced as a byproduct of mining other metals such as gold, lead, and zinc. This means that its supply is partly influenced by the economics of those metals as well. Even if silver prices change, production may continue if it remains economically viable within broader mining operations. Another area of discussion involves global trade flows. Silver, like many commodities, moves across international markets. Different countries play roles in mining, refining, and manufacturing. Shifts in trade patterns can influence where metal is processed and how it enters the supply chain. Some analysts also explore how different market systems interact. For example, physical metal markets and financial markets may not always move in perfect alignment in the short term. Over longer periods, however, they tend to reflect underlying supply and demand fundamentals. It is important to avoid oversimplifying these relationships. Markets are complex systems influenced by many variables. While certain trends may point in a particular direction, outcomes are never guaranteed. From a policy perspective, governments often face difficult decisions. Environmental protection, economic development, and resource management must be balanced carefully. Policies that limit or regulate mining may aim to address environmental concerns or promote sustainable practices. At the same time, such policies can influence investment decisions within the industry. Companies typically evaluate long-term stability before committing to large-scale mining projects. Clear and consistent regulatory frameworks are often important for attracting investment. When uncertainty increases, companies may delay or reconsider new developments. This does not necessarily mean that investment stops entirely. Instead, it may shift to regions where conditions are more predictable or favorable. Over time, this can influence the global distribution of production. For viewers and observers, the key takeaway is that the silver market is shaped by a combination of supply factors, demand trends, policy decisions, and technological developments. No single headline captures the full picture. Price movements, for example, reflect a wide range of influences. They can be affected by industrial demand, investment flows, currency movements, and broader economic conditions. Short-term volatility does not always indicate long-term direction. It is also important to approach financial topics with a balanced mindset. Discussions about markets should focus on information and analysis rather than certainty or prediction. Conditions can change, and new developments can alter the outlook. As the global economy continues to evolve, materials like silver will remain important in many industries. Ongoing innovation, policy decisions, and market dynamics will shape how supply and demand develop over time. For now, the situation highlights how interconnected the world's resource systems have become. Decisions in one part of the world can influence industries and markets elsewhere, sometimes in subtle ways. Understanding these connections can help provide context, but it is always important to remain cautious about drawing firm conclusions. Markets adapt, industries innovate, and new solutions often emerge over time. In the end, the story of silver is not about a single event or decision. It is about a broader system that continues to change, influenced by technology, policy, and global demand. Watching how these factors interact over the coming years will provide a clearer picture of where the market may be heading.